All right, I just need to see if this is working really quick. Give me 1 second, guys. Alrighty, you should be able to see this. So today we are going to value iRobot, or start the process of valuing it. Let me just. All right, let's get started. So iRobot, as you all know, is a consumer electronics company. They make vacuums. They acquired Roomba a while ago, and they just have a strong IP. So as always, we'll start with revenue. Let's see. We're gonna have to go back years and years. I want to start pre-COVID, right? When you're valuing something, you want to look at their pre-COVID numbers just to get a feel for how they were on a normalized level before any serious, crazy abnormalities, right? Get rid of that. Here we are. This is their 2019 10K. All right, let's get started here. So, start the income statement. Hmm. This is all they have. Okay. I'm gonna assume that they have all of these line items here. Um, they have to, right? Your classic expenses. Administrative. Maybe they have some restructuring. All right. Sorry, I have a work computer next to me, and I have a different keyboard and mouse, obviously. And I'm not used to this. I'm not used to this keyboard, so it's just a little bit more firm, I guess. All right. We'll do a little bit of formatting here. Bold revenue, bold gross profit, and we will start modeling this out. So if you would pay attention over here, where did that just go? Here we are. Pay attention here. I'm going to be entering these financials in. More formatting. We'll do accounting. Always accounting. All right. Cost of goods sold. Oh, they don't even give us that. They give us gross profit, so we'll have to back into it. Super weird. super weird. They give us operating income. They didn't give us anything. Okay. Shares out. Cool. Okay. Sometimes you have to do a little bit of digging here for the other expenses. Oh, okay. Okay. Oops. Looks like they do have an actual income statement. Thank the Lord. Might have to. Oh, looks like I got all these. I hate this fucking keyboard. Alright. No restructuring. Perfect. Sorry, I had to answer a work email. Okay. Other expense. Or income, right? Could be income. Who knows? And in this case, it is. Pre-tax income. About 100K. Taxes, taxes, taxes. Okay, they do pay taxes. Sorry, I'm like missing keys over here. I mean, this is crazy. This keyboard is not very friendly to me. All right, for EBITDA, we're just going to keep it simple. We're going to start with operating income. We're going to add D&A to get a very simple, quote unquote, EBITDA, right? And then we'll add back stock-based compensation. We'll add back any restructuring, which there isn't for this fiscal year. Um, restructuring expenses tend to be one-off, right? And we'll eventually arrive at some kind of adjusted EBITDA. I'll be adding back more to that as well. And let's see here. We'll do margins and growth rates. Boom. We'll do revenue growth, right? Again, I'm sorry guys. This keyboard is causing me some issues. We'll do gross margin as a percentage. We'll do EBITDA margin as a percentage, or maybe we'll change that to adjusted EBITDA. And we'll do OpEx as a percentage of revenue. This is always something really key to track, right? Especially for a company that maybe they're generating some operating leverage and they're simultaneously reducing this OpEx, operating some of these operating expenses, maybe in G&A or selling, maybe they're laying people off, right? And OpEx is actually declining as a percentage of revenue. It's typically something that you see during a restructuring, or maybe again the company's generating some significant operating leverage. So just something to look at. So this is going to be a little bit messy because I can't really see what I'm doing. Because I have this window minimized so I can fit another I don't even know. Can you guys even see my screen right now? Let me see. I just looked at the stream. It doesn't look like you can see anything. Okay, it looks like you can. Okay. And we're back. All right. All right, so EBITDA, operating income. Now, depreciation and amortization, um, you can find on the cash flow statement. D&A is embedded within either COGS, if there's, or it's embedded within certain expense line items, right? They don't explicitly show it on the income statement, but it is there. So it's your job to hunt it down. We have to look for the cash flow statement. So let's do that. Boom. Let's see here. Cash flow statement is right here. And here we are. Voila. We have 37 million. And I always source this or cite this. Let's see, page 47, 2019, 10K, right? If any other analysts want to check your work or QC your work, you can leave them a paper trail. Stock-based comp, as you see right here, 23.7. Increase that again for you guys. 23. What just happened? There we are. 23 million. Restructuring expenses. We can link those up here. Just have a feeling we're going to be seeing some. Revenue growth year over year, not applicable for the first year. We don't have another year to compare it to. Gross margin actually seems pretty good. In the 40s, we are. EBITDA margin, a little bit under 10%. Oh, wait, no, 12%. And let's see, minus all of the OpEx. Divide this by revenue. This is going to be hefty. 37%. We can just carry these forward, right? We just carry these forward. Not these, though. Okay. Just carrying the formulas forward, so all we have to do is populate this. All right, next. Back to Edgar. And we want the next 10K, which will be right here. Boom, here we are. All right, wow. Significant revenue growth. Let's see. Other income. Oh, whoops. Other income. Tax expense. Wow. 47, or about 40 million in taxes. That's a lot. We can get that as a percentage. Just a quick sense check to see how much they're paying in taxes. Yeah, got the corporate standard. Back then, right, under the Trump admin, about 21%. Again, we're going to look for depreciation and amortization. Now, the cash flow statement is a little different than the income statement, right? This is going to be, oh wait, I'm not doing quarters yet, so I can just enter this in. Stock-based compensation is 29,975. Yeah, the cash flow statement is different, right? This is, in finance, there's something called accrual-based accounting. right? And also GAAP, generally accepted accounting principles. Um, and now, the real role of the cash flow statement is to show shareholders and whoever wants to investigate the company, like, what are the actual cash flows, right? Customers can pay on credit, and the company's paying its vendors and whatnot. Where are the cash inflows and outflows associated with accounts payable, receivable, inventory, right? What are some non-cash expenses that don't really impact cash, like stock-based comp and depreciation? I shouldn't say stock-based comp. This is a really sort of complex argument that you can make just due to share dilution and whatnot. But D&A is an add back, right? So the difference between revenue and net income, I guess, reported net income and actual cash outflow or inflow from operations is, just there's a lot that goes into it, right? So that's why you look at the cash flow statement instead of just looking at net income, or EBITDA, right? Uh, there's a lot more to going on behind the scenes that you might not be able to understand if you don't look at the cash flow statement. Long-winded answer there. All right, so year-over-year revenue growth, they are growing, and pretty rapidly for a company that already did $1 billion in sales. They grew almost 20%. I mean, that's just it's kind of bonkers to think about, right? We need the. What's this for? Yeah, we missed one. Here it is. Financial statements. Click that hyperlink. It'll bring you right down. So they start with the balance sheet. We want the income statement, obviously. Oh, they actually got a benefit. Interesting. I always use diluted shares outstanding. I mean, we can go through and calculate dilutions from convertible notes and equity offerings, right? But they provide the calc for you at a high level there, so it's best just to use it. But when you're doing equity valuations and looking at different stocks and companies, right? Not only do you have to understand the company and how it runs and key employees and the financials, but you also have to understand the capital structure and how much debt is outstanding. Is it revolvers, term loans? Who do they owe money to? What are the maturities in some of this debt? And you can figure all that out. They provide all that information for you, and it's your job as an analyst to acquire that information and lay it out and understand it, which includes a dilution profile, right? Um, I would argue that dilution is a shareholder's worst enemy ever. Now, what happened here? What happened here? Whew, boy. Let's see these margins now. So we had serious, we call this gross margin, or just quote unquote margin compression. Why? Well, we'll come back to that, analyze that. But their gross margins just fell off a fucking cliff right there. And that is an equity analyst's or a shareholder's second worst nightmare is, I would say, margin compression. The third behind that is obviously uh, a decline in revenue growth, which just happened in 2021, at the end of 2021. And yeah, this is not good. Just from experience, this is not good. I'm actually curious to look this up. Um, I bet you they really struggled from 2020, the beginning of 2022 and on. I bet you they really Yeah, wow. Yeah, that's not good. They are in the red, but we're looking at this for a reason. I do think that there is a lot of money potentially to be made here. Not financial advice, it's just my own opinion. Okay, next 10K. And then we're going to start getting into some of the quarters, right? Instead of just modeling out a fiscal year, it's good to get a little more into the weeds and start understanding seasonality and, which quarters does the company generate the most revenue and, um, just to dig a little deeper. And you also need the quarters to calculate a true LTM revenue. So keep forgetting this. 12 R&D. And I woke up on a mission today to get some freaking work done. And we are doing that. This is more of a side job slash hobby for me. Yeah, look at that. Look at the earnings per share there. Look at this. Whew. Man, absolute beatdown. Absolute beatdown there. This company is struggling much. Stock-based comp. Still no restructuring going on. There will be, I'll tell you that much at this rate. And just like that, company is in the shitter completely, right? Obviously, it didn't happen overnight. Uh, there are many reasons for this. Sorry, I'm just signing into my other computer here. There are many reasons for this, and obviously, if you looked at the first quarter of 2022, you'd probably have some red flags going off, but it is still pretty insane to see that drop off. Here, I'll do this for you guys. That way you can see everything over here. All right, on to the quarters. The first quarter of 2023. Let's go grab that. And guys, if I have to randomly go, if I got a work call or something, I will end the stream and I will start up part 2. So just bear with me. All right, operations. All right, now we're on to the quarterlies. This is where it gets fun. Okay, let's get a true up. Other expense, taxes, it's a benefit. Shares out, 27 million. Depreciation and amortization. And stock-based comp. 7932, perfect. Okay. We should do an NA here, right? Because you can't compare annual revenue growth to quarterly, a quarter to a year. Gross margin still the same, EBITDA margin, and OpEx. So look at this. I mean, it's just a disaster. Revenue growth slowing, actually negative revenue growth. Revenue is declining. Gross margin compression. Their cash flow is likely in the negative, just judging by their EBITDA, and their operating expenses are still 50%, and now 70% of revenue. It's crazy. It's absolutely insane. All right, next. Research and development, 37, almost 38 million. We have, cool, operating income. Other expense, about 4 mil. Just dragging those formulas over, and they paid almost 6 million in taxes. All right. Diluted shares outstanding, 27, almost 28 million. Earnings per share of $2.93. Now for DNA. So here, since we're dealing with quarters, right? This is the cash flow statement is never really reported on a quarterly basis. Uh, it's essentially cumulative. So this is 6 months. So we don't have the 3 months. So we're dealing with 6 months of DNA. So to figure out monthly, you simply just take the total amount and subtract the prior quarter. The same thing for stock-based comp. Great. We're going to need these as well. So we don't have any other prior quarters to compare revenue to, right? All right. Balance sheets. We are going to make a balance sheet. All right, revenue. We're going to do everything. We're going to do everything and actually put a value on this sucker. Because I think that there could potentially be some money to be made here. Cool. Again, DNA, go all the way down. We have 21 million. Now we're going to do minus sum, take the last 2 quarters, right? Subtract from the last 2 quarters. Same thing for stock-based comp. No restructuring charges yet. They're coming, believe me. Cool. All right. Sense checking all that, making sure I got all of it. On to a 10K, right? Because we are at the end of fiscal year 2023. Okay. So again, this is sort of unique, right? They gave us the entire year. So we're going to have to subtract the last 3 quarters to get this on a quarterly basis. Right? Hopefully this makes sense. And then we can true everything up at the end. Once we have all the numbers punched in, and make sure that no restructuring yet. I mean, it's just crazy. Other expense, we had less taxes. All right. Get the depreciation total for the year. Okay. Stock-based comp for the year is 36 right here, if you are paying attention. 36 million. For the quarter, it's about 10 million. Boom. We have our kind of rough adjusted EBITDA here. Okay. So what we do now for fiscal year 2023, you could just enter the numbers in, right? financials in from the sheet, but we already have them. We already have all the other quarters, so all you have to do is this. Essentially just sum everything. Now for this calc, you actually do the average number of shares. That doesn't seem right. And it is. It is right. That's just crazy. So a fall from glory for iRobot. Clearly, this company struggled big time over the last couple of years. But it makes for an interesting story, and we need to learn about it. Why did this happen? Why did their equity fall off a cliff? These are all really important questions. Just going around and unbolting things here. You know, it's really important. Everyone just kind of rushes through this, right? But it's really important to format things properly and neatly, because in the professional world, other people are going to be looking at your work, and you want them. They might not be as intelligent as you, or maybe it's their first time looking at equities, or maybe debt. Um, so when you're analyzing something, it's good to analyze it from the perspective of, other people are going to be looking at this. So how can I present it? And sometimes you can't always present it neatly, but oftentimes you can. All right, first quarter of 2024. So there's some share dilution going on. As you see here, 28.7 million shares, whereas just 3 months ago from this quarter, they had about a million less shares. So they're issuing equity, or maybe it's a dilution from stock-based comp. Who knows? You need to read about that. All right, here we go. 115 million in revenue. Wow, they're still dropping like a stone here. Wow, what is going on here? A positive cash inflow into G&A. We need to read about that. Here are the restructuring expenses. Okay, I knew it. Reformat this. I just reorganized the line items so it'd be easier. That way they match the financials over here. You can see that restructuring is actually above the amortization line item now. 14 million in restructuring. Wow. Okay. And they're EBITDA positive because of this. So what happened there? We need to read about that. Once we get this done, we'll do a little research. Right, other expense. Taxes. Diluted shares outstanding. Wow, okay. I just got a notification, if you could see that my streaming software disconnected. Am I still live? Let me see. Sorry. Looks like I'm still live. All right. Let's go get this depreciation and amortization for the first quarter of 2024. Almost 6 million. They're still going heavy on the old stock-based comp. Wow. Whoops, I can't do that. Sorry. All right, there we go. All right, now let's see what happened here. Okay, so here we go. This might be a little boring to you guys. I'll read it really quick internally and then I'll summarize. Okay, so essentially They had an M&A agreement with Amazon. Amazon was going to acquire iRobot, all their IP and assets, the company. And it looks like that M&A fell through, the deal fell through. And the company, Amazon made a cash payment of 94 million to iRobot as a result of the termination of the merger agreement. And then iRobot took that 94 million and paid off some of their term loan. They used 35 million of the 94 to pay off some of the term loan. Okay. Uh, Interesting. So that's why G&A was a little wacky. Okay. I just wanted to understand that for my own sake. All right, let's get these revenue, year-over-year revenue growth rates. So first quarter, we can compare this now, revenue, right, to the first quarter of 2023. They're down. All right, onwards. Next quarter is going to be the June quarter. Perfect. Research and development. Okay, so now they're starting to cut costs here. Now they're starting to cut costs. That's interesting. A little late to the game. Company's already in the shitter. What did I do here? I think I entered something in wrong. Oops. Catch your mistakes early. Even little mistakes like that would potentially land you in the hot seat. So that's why you always have to be paying attention when you're putting in these numbers. All right. Really, really pay attention. Otherwise, you could find yourself without a job, right? Nobody wants that. Restructuring expenses, I already have that linked. I don't know why that. There we go. Okay. So yeah, so this was not a normal period here. Normalized. They're still in the red. Um, Revenue is still declining. Right? They did 236 million in the last quarter two of 2023. They're only doing 166 million now. So margins are way down. Holy moly! All right, they were in the 40% back here when the company was really healthy, and they've declined all the way into the teens. I mean, you just don't see that. You just don't see that very often. That's really sad. All right, on to quarter three. On to quarter three. Pre-tax income, taxes. About $1 million in taxes. Net income still in the red. That's better though. Diluted shares outstanding. So they really are diluting. Something must have happened here. Appreciation, right? minus 2/4. And we have stock-based compensation of 5.5 million. They are EBITDA positive, which is interesting. So they're back to EBITDA positive. Okay. And that is in Q3 of 2024. They're back to EBITDA positive. Wow, gross margins increased. They doubled their gross margins. Revenue is growing year over year again, and their EBITDA margins are even positive, right? And OpEx is significantly down as a percentage of revenue. So big changes. This I would call sort of, I would mark this. This is an inflection point for me right here. This is an inflection point quarter. And this is where investing gets interesting, right? The more experience you have, the easier it is to identify these types of situations. So, all right, and there, let's see if, I don't think no, it's not released yet. Full year is not released yet. We have to wait for March, I believe. Let's see when they released their last 10K. Yeah, pretty much. Late February. Okay, well, really quick. So that is the income statement. Just gonna back out so you can see the whole thing here. Why don't we start the balance sheet? And I'm just gonna get a quarter in. The most recent quarter. I'm just gonna get that in. Just starting it. Balance sheet always starts with current assets, and assets are listed in order of liquidity. So we'll go to the most recent balance sheet, which is going to be September of 2024. Their balance sheet is reported right here. So cash and cash equivalents. They have some restricted cash on their balance sheet. Accounts receivable, obviously. Just customers paying on credit. That is, you can't recognize that as cash, right? Inventory. We have, sorry, going back to accounts receivable. If it declines, it's a cash inflow. If accounts receivable increases, obviously that's customers paying on credit. That is, that's a cash outflow, right? You have to subtract that from net income. That's accounting. We are doing more corporate finance here. All right, so total current assets, can add property, plant, and equipment. You guys can also abbreviate these. I don't really care. I'm just doing this how I want to. Tangible assets. Other assets. They will typically have a breakout of what are embedded within other assets. So, okay. So we're cruising here. Now I'm gonna do this quarter of the balance sheet, and then I am going to do their capital structure as well. So here we are on the balance sheet. We are on liabilities, current liabilities. Is total current liabilities. All right, so they have debt. For those of you that don't know, a term loan is debt. So they engage with another party to receive some kind of credit. And there's a pay down schedule, and good news about a company being public is that we can find out every detail detail about it, about that debt that they have. Who the other party is, the interest rate on the debt, pay down schedule. I'm gonna guess it's SOFR plus some kind of credit spread. SOFR is the secured overnight financing rate. All right, let's start entering these in. So we'll just copy this down, the time periods. Copy this down. And here is their most recent quarter, right? September. So let's get this in. So they have almost 100 million in cash and cash equivalents. They have 41 million in restricted cash. Property, plant, and equipment, 25 million. Boom. Accounts payable. Around liabilities, again, listed in order of liquidity, right? Cash, restricted cash, etc. All right, now we get to the fun stuff. Now we're on long-term liabilities. This term loan outstanding. So this is the listed amount of the term loan that is outstanding, right? So when a company engages with another, either private credit or bank to source liquidity, they often source debt. A term loan is debt. So we can read about this. Now, that 186 million or whatever the original amount will appear under the liabilities section, and the offsetting journal entry would be to increase cash and cash equivalents, right? So that is where all this debt goes. It goes into the cash line. It looks like they've used most of it already, so they're paying it back. Operating lease liabilities. Let's see. Where am I? Right there. All right. So this 500 million matches what I'm seeing. Time for equity. Whoops. We're going to have common equity. We're going to add APAT or additional paid-in capital. Add. This is really retained earnings, right? Company's never generated a profit. Retained earnings are essentially the aggregate net income that the company's generated over its lifetime. Sorry, I just got confused there. Okay. Okay. Let's fill out the equity section. All right. Now you need to balance. Balance sheet always has to balance, right? If it doesn't, something's messed up with it. So I just do this simple equation. Maybe I got the assets section wrong. I think I did actually. I'll find it quickly. This is where we got it wrong. You big dummy. All right. fix this calculation down here now. Format it first. Fix the calculation. Now it's balanced. Okay. We want that here. Oops. Okay. All right. Let's start on the capital structure. Okay. So, capital structure summary, right? So looking at the company's debt structure, debt profile, how much cash they have on hand, and I just do a valuation as well, like a mini, not an actual market valuation, but like where's the company currently trading at, and whatnot. So let's see. Let's look up their debt. So there's always going to be a section here on the SEC filings for debt. So you can see right here, July 24th, 2023. The company entered into a credit agreement, and among the company is borrow each lender from time to time. Huh. All right, so they borrowed $200 million from the Carlyle Group, essentially. Total proceeds were 188 million. So 188 million of cash actually went to the company's cash reserves, and 12 million, obviously, those are the costs that went into the deal. Interesting. All right, here is the interest rate, like I said, SOFR plus a 9% spread, or a rate based on the base rate plus a rate adjustment plus an 8% spread. Oof, mouthful. All right, so, and it's senior secured, right? So it's not mezzanine, it's not subordinate, right? So it's gonna get these guys are gonna get their money back if the company goes belly up, right? They're first in line to get their money back. So we have a $200 million senior secured term loan. We are gonna add a note here. If you hit Alt 7, you can do a bullet point. Do there, and it's due, as you see, 2 years or 3 years from the date that it was negotiated. Due July 4th, 2026. All right, so up here, what we're going to do is we're going to make these larger. 20. Going to make this way larger. So this is how I set these up. Market price of the debt, the actual market value, it should just the actual interest rate, which we see, the interest expense, and the availability. Obviously, for a term loan, it's immediately available, right? The revolver typically is on a pay down schedule. You pay it back. It's like a credit card, so you can check the availability on that. But this company doesn't seem to have any revolvers. This seems to be the only debt outstanding. So outstanding, we're going to do 200. we're not going to do 200 million because that's right. They used the $35 million from the parent termination fee to pay down. So they repaid a portion of the term loan, which is 35 million. So there's only 176 million outstanding. Okay. Interest rate is, I have to do some research here. What is the SOFR rate? 4.35. So plus, make this a percentage, right? Plus 4.35 plus, we'll just do the spread of 9%. Okay. Um, Hold on, I just want to make sure 8 or 9% spread. So that's cool. 13.35%. All right, the interest expense is simply this. Availability, it's fully available. It's already reflected. All right, so total debt. This is their total debt. Wow, okay. All right, now we're gonna go for net debt. Net debt is simply total debt outstanding, which is just this one term loan. Must be nice. We're gonna get cash and cash equivalents on here as of the most recent quarter, about 100 million. We're going to subtract those for the net debt calculation. Okay, that's 76 million in net debt. Now, we're gonna get the share price. iRobot share price, it's $7.48. I like my share prices in currency, just looks neat. You always want to source site when this was. 2025, we'll do as of. All right, we're gonna multiply this by shares outstanding. That'll give us our market cap. Give us our market cap. We pulled that. Shares outstanding can be pulled from our financials tab right here. They have about 30 million shares outstanding. The market cap is 227 million. Now we're going to add any net debt, any debt associated with the company to get to the enterprise value, right? So why are we doing this? Why are we adding debt? Well, you have the equity value, right? So maybe someone would pay 227 million for this company. That's just the equity value. But they'd have to take on the debt too and the cash, right? So we add this. We simply add this to the valuation. They would have to take this on. So if somebody wanted to buy this right now, at a sort of a fair market price, they'd pay likely $300 million for the company. Now, if there were synergies, maybe they'd pay a little bit more. Obviously, we have to do a discounted cash flow valuation on this, or some kind of multiples valuation, maybe a combination of the two, right? The income approach and the multiples relative valuation approach. But this company's worth, in my mind, $300 million at a bare minimum, right? Could be worth half a billion dollars. Who knows? But a fair market price, this is typically just a good exercise to do, just to become comfortable with valuation in general, right? These metrics right here are really important. Cash, debt, enterprise value. Boom, we're done. Now, something else that is really important. Do a little liquidity overview of the company. How are they doing, right? So for this, we're going to need another period of the balance sheet. So we'll go back to June. Oops. All I need is the cash balance, the June cash balance. June cash balance was 108 million. And we will come back and fill out all these other periods of the balance sheet. You don't really need to, but okay. So at the beginning of the period, right? They started with 108 million of cash. Now they burned some cash, right? Or maybe they had an increase in cash, right? Maybe they issued equity or they issued more debt. Who knows? Maybe they generated a profit and that profit went to, increase their cash balance. In this case, they actually burned some cash. This company is burning cash, right? They don't have any cash flow. They have cash outflows, right? They have to pay employees, right? So this company is sort of a sinking ship, although there is sort of an inflection point and they might be able to save themselves. So how do we figure out the cash burn? Well, it's simple. You just take the current period that you're working with and subtract the prior period. About a $9 million. What am I doing here? About a $9 million cash burn. That's how much cash they burned period over period, which we're looking at 3 months here. We're looking at 1 quarter. Okay. That's end of period liquidity, but that's just high level. Now, what about any secondary offerings, right? We saw some share dilution when we were doing our income statement. So secondary offerings. So let's check. Let's check. How about this? And boom. Here we go. Stockholders' equity. At the money, ATM stands for at the money equity offering. So in February 2024, the company entered into an at the money equity offering sales agreement, the ATM agreement, with Bank of America Securities, pursuant to which the company may offer and sell from time to time at the company's option up to an aggregate of 100 million in shares of common stock through B of A as sales agent in an at the money market or in an at the market offering. All right. B of A is obviously loving this. They're going to collect fees, boom, share dilution. And let's see, did they use this? They did. This company sold shares in the first and second quarter of 2024. Okay, so we need to record this, right? Page 20 of 2024 Q3 10Q. And we can just add the proceeds. So they received proceeds from an equity offering. They received $30 million. Okay. That's likely already reflected in the cash balance though, because this is in the second quarter. So I don't think that we have to. Let's do some research. Yes, that's already reflected. This is where you'd add any revolvers, which they do not have. These are revolving credit agreements. So you have sort of total liquidity. You have a picture of total liquidity at least. And now we can divide by the quarterly cash burn. And you can get your cash, something called a cash runway. Something called a cash runway. So total liquidity. About 100 million. The quarterly cash burn, about 9 million. Okay. So they have about 11 quarters of cash if they continue operating at this pace. So they have plenty of room, And I would assume that this debt right here would eventually get renegotiated. I mean, 13% just seems a little high, but what do I know, right? Um, Other metrics we can calculate, do LTM EBITDA, we'll do net leverage ratio. LTM EBITDA. We'll take their adjusted EBITDA. We'll be generous. It's 3 quarters. It's 4 quarters. Net leverage is enterprise value divided by EBITDA. It's not even worth it. And yeah, that's a high-level overview of Roomba. Now, this is just part one of kind of the valuation that I'm doing here. Shit, what happened here? Okay. Just delete all these. Shift these over. It's my fault, not paying attention, moving quick. But anyway, this is part one of kind of the stock valuation for iRobot, and we will continue to work on this one and eventually have an all-encompassing equity valuation model. But that's how we look at an income statement, a balance sheet, capital structure overview, and hopefully you guys are learning from this and it's helpful. So if anyone stumbles across this video, please leave a comment. Let me know what you think, and I'd really appreciate it. And again, this is not financial advice. I have no equity stake in Roomba or in iRobot as of the 3rd of February 2025, and I'm not recommending to buy this stock at all. So hopefully everyone does their own due diligence.